Welcome to another episode of Wealth and Toil. My name is Luke Laretive and I'm here today again as per usual with my friend Dylan Pargiter-Green. DPG, how are you, mate?
Very well, mate. Always a pleasure, never a chore. This Tuesday recording session with you.
Now, my mum and you and all of our regular other 5 listeners will notice that we're no longer, we're not in our current Riverside digital studio or at the office in Melbourne. I'm actually in the Equity Mates studios because today we are with the myth, the men, the legends, Bryce and Alec from Equity Mates. Boys, thanks very much for doing this.
Thank you, Luke. Dylan.
Yeah, boys, good to be here.
We're trying
Thanks for coming on, guys.
We're trying to do a bit of a deep dive into people's businesses. You know, we're interested in business owners and financial planning on this pod. And so today we're not going to do the Equity Mates thing. We're going to do the Luke and Dill thing, which we'll see how that goes.
No, we're looking forward to it.
You sure? You don't want to do the Equity Mates thing? I feel like it's a proven strategy, whereas the look and deal thing, not so much.
The Equity Mates thing is be the dumbest people in the room, but let smart people talk. So you guys just go ahead and teach us.
Yeah, well, I don't know about that, but we'll try and have an interesting convo nonetheless. I'm probably not... I've worked for you guys. I know a lot about your business, but I don't think a lot of other listeners would know maybe as much about how the Equity Mates machine works. Maybe rather than going through origin stories and stuff, could you just tell us maybe a little bit about how you see the podcast kind of landscape, your sort of competitive landscape, for lack of a better word, and what you guys are trying to do in terms of positioning your business and for growth and for yourselves as a lifestyle business or as an acquisition target or whatever it is going forward? How are you thinking about your business at the moment?
All right. So I think we found ourselves in a pretty good sweet spot, not by any grand design, but by being in the right place at the right time. And I mean, that's the first lesson from Equity Mates. And I guess for a lot of businesses in general, it's like the beauty of being in the right place at the right time is better than any competitive advantage. Like, we've just ridden a number of waves. We've ridden the rise of digital media and podcasting. We've ridden the rise of retail investors. And we've also ridden the decline of financial advisors. And that might be controversial to say to 2 advisors, but...
Tell me about it.
You guys have seen the industry...
Decline in numbers. Decline in numbers, not in quality.
Yeah, that's it. Yeah, only the best have remained. But
the cream rises to the top.
Yeah, what those 3 sort of forces have led to is a massive rise in the self-directed DIY investor. And we've been in the right place at the right time to, I guess, service them and capitalize on that. So, you know, Equity Mates today is 2 flagship podcasts, Equity Mates Investing and Get Started Investing, which Bryce and I host. And then we have a production arm where we produce podcasts for other people, both in the industry and just people like us who are sort of talking about, I guess, the industry and finance. So that's sort of the business, but where we sort of want to position ourselves in the landscape and where we think we add value is really connecting 2 worlds that weren't talking to each other that well, which is the world of big fund managers and also sort of, you know, high-level advisors and this, you know, self-directed investor. And we work with a number of big institutions and fund managers to try and sort of get them and help them speak to a retail audience at scale, because that's hard to do at scale.
Really hard to do.
But then for the retail investor who, you know, can't afford the services of people like yourselves, or perhaps can't afford the minimums of some of the more expensive funds out there, we try and give them a platform to ask their questions and learn about this world. So we really see ourselves as the conduit between those 2 worlds, and it's going well so far, and hopefully no one kicks us off our perch.
No, you guys are going beautifully. Bryce, do you find that running the business today at, you know, a substantially larger scale than it was, you know, say 2 years ago, and maybe the challenge of the clients or the advertisers that you're dealing with now is different, difficult, more challenging, less challenging? You know, how are you finding it personally, I suppose, managing a team and some of the other challenges that come with sort of scaling a business, for lack of, I hate using that word, but you know what I mean.
I mean, no doubt we are facing different challenges to what we were facing 2 years ago. I think 2 years ago, it was probably Ren and I, and we had one producer and we'd raised some money. And so we were thinking about how do we want to allocate this, put some fuel on the fire to really accelerate growth. I think the biggest challenge we face is people. Like Ren and I probably spend more of our time thinking about the team that we have, how we're going to grow the team. Do we have the right people in the right in the right spots, in the right jobs? What is the next best hire when you have 3 or 4 things that you want to be doing? And at a scale that we're at, like yes, we are bigger than we were 2 years ago, but we're still only 6 to 8 people on a rotating basis full time. So every hire is critically important. And so that's a big challenge, and we've probably made some good calls, and we've learnt a lot over the 2 years when it comes to people. In terms of the revenue side and the partners that we work with, that's probably got easier because every year that goes by, we do, we have more opportunity to build brand in the industry, and people, we work with a partner for 12 months and then they understand what we can do, we can show them value. And so the work that goes into trying to convince them to come on in the first place gets easier with every sort of rolling 12 months because they understand.
You got a relationship, essentially.
Yeah, we have a relationship. And so we're in a semi-fortunate position where, we're still having to chase advertising dollars. We're in an advertising business, that is media, but the dollars that we are chasing, I'm not going to say it's easier, but yeah, the relationships that we have with some of the leading
more established
providers here in Australia makes it somewhat easier.
It's really interesting, right? Like a lot of these things, I think a lot of people listening to podcasts generally probably don't think about people running a business behind a podcast. Like, I dare say that people, often just put on whatever, podcast they're listening to and think there's just 2 blokes sitting on a couch in a room somewhere with a couple of microphones having a yarn, and that's all that it is. But it's an amazing amount that actually goes in behind the scenes. That coupled with the fact that a lot of the business things that you're talking about are normal business, startup, growth, building
challenges,
strategies. Yeah. They're things, staffing costs, making sure that we've got critical hires for growth strategies. Those things they're not uncommon in any industry. But I think it's really cool to hear you guys talking about it, painting a much broader picture, for people to understand how the Equity Mates Media machine actually works behind the sultry tones of your 2 voices.
Yeah, I mean, one of the most common questions we get is, how do you guys make money? And there's plenty of ads on the podcast, so you can probably figure that out.
Yeah.
But like the way I always explain... The way I always explain it, it's like it's one of the oldest business models, and it's just the medium changes, and it get people's attention and put ads against it, and that has been the media business model throughout, print, radio, TV, everything, and it's just that this media environment is far more fractured, and there's far more options, and CPMs, which is cost per 1,000 impressions, are lower. But it's, the same model that every media organisation runs.
It's the same model every business runs, essentially. It's, finding people be aware of your particular product and then, getting them to ideally buy that product. Like, it's pretty simple. I mean, a lot of the things that Bryce was talking about are the same things that we face at Seneca, It's no different. It's always the same, and the scale problems, things change, and the problems might change, but at the end of the day, that's what entrepreneurship is. It's, being able to adapt to a changing set of problems as ideally your business continues to get bigger and bigger and more profitable.
Well, I guess one of the big differences though between your revenue model and a media revenue model is if we don't transition the business to some other form of product or whatnot, then we don't have a recurring revenue model, so to speak. Every month, every year, Ren and I have to front up and go from essentially zero again to sell that media asset time and time again. As much as we say we have long-term relationships, all it takes is a few of them to say, budgets are pulled, we're not in for this 12 months, and your whole revenue model is under pressure.
Yeah.
And so the challenge that Ren and I have is extracting, or we provide a lot of value for our audience, as Ren said, connecting with experts, providing them a level of general advice that they would otherwise have to pay for or struggle to get. And so for us, it's how can we create meaningful revenue models around our audience that aren't just relying on chasing our advertising partners.
I think that's really important, and I like recurring revenue for lots of reasons, and I'm a bit of a student of, like, Adobe's my favourite probably business story that I've ever heard, right? They had a transactional hardware sort of software business, and then they've gone to this online subscription model and, onto, amazing things. And I just learn a lot from that. Stockbroking is obviously the transactional model, and that's kind of been my background. And then moving into a recurring revenue advice business has been the best thing I've ever done. My revenue had to go down to be able to achieve that, but now we've sort of grown past where I was before, and hopefully continue, and it's a much stickier business that allows me the time to produce a better product for my clients every day. I wonder if for you guys, if a recurring revenue business, do you feel like that would improve your product if you had more certainty? Is it something that, do you think holds you back?
I don't know if we're going to agree. I don't know if we're going to agree on this. I think that I think the quality of the product is still good. Don't get me wrong.
I think it's great.
But I think any time you have to do more sponsored content or you have to have more advertisers, it just detracts from your focus and what you want to do. And, there's only so many episodes a week and so many things you can talk about. So I think it would probably... If we had, if media was top of funnel and there was an advice business under it, or a broking business under it, or a fund manager under it, and that was where we made the money and we didn't need to make money from the media business, yeah, I'm sure that we could do different things with the media business.
Would the media business work, though, in that setup? That's kind of my question. I think what people struggle with as sort of clients and individuals looking for advice or, expertise in the investment space is they can't trust any of the top of funnel guys who have a product underneath it. They feel like it's all conflicted and they're kind of just getting scammed all the time, which isn't true, but it's how they feel. And that's why you guys have done so well. It's being this sort of third party. Okay, I wouldn't use the word independent, but it's definitely segregated.
I would use the word independent.
Would you?
Yeah. I mean, we take money. We take money from a lot of people, but we're not beholden to anyone.
That's fair. I suppose in our land, we can't even. I'm not. ASIC don't even let me spell independent, let alone use. let alone use it. But that's a story. That's a story for another day.
I think the way to look at that, though, is that we've done the reverse to how everyone else does it. Is everyone else goes out, creates the product, creates their fund, whatever, and then tries to build the media on the top. And it's very hard to do that.
Why are you looking at me like that?
It's very weird. That's a bit close to home, mate. But no, you're totally right. Having a product and then flogging it through your own media is new wave vertical integration, whereas creating a media audience and then introducing something that helps a whole bunch of people, I can see a huge market for that. I don't know exactly what it is, but because you've got that audience who trusts already the process, trusts what you're talking about, and if you can find genuine value for those people, then 100% recurring revenue is going to be a wonderful thing to achieve for you guys in the next few years.
Could I pivot perhaps a frac and talk about your own investments and your own dough and
you
all the hard
You also
stuff?
don't have to ask to pivot. It's your show. You can just pivot.
It's interesting, I think, because perhaps that source of recurring revenue does become some sort of investment related thing, and
makes your business worth a lot more. I'll give you the hot tip.
Yeah, I mean, people have said, would you do an ETF? And, I'm sure there'd be some sugar hit from putting the Equity Mates name on an ETF.
Yep.
But, Bryce and I very deliberately don't position ourselves as experts, partly because we're not. We didn't study finance. We're not from the industry. We haven't worked in the industry. But also we think that generally financial media for generations has been experts talking down to everyday people. And even if you think about, the Koshis or the Paul Clitheroes or the Scott Papes, like the Barefoot Investor, they're the most accessible people from a generation before, but they still were all positioned as experts talking to everyday people. Whereas I think something that Bryce and I have had an advantage in, and it wasn't deliberate, it just sort of came about, is that we are not experts. We'll ask the dumb questions and we'll make stupid mistakes and we'll share our mistakes on the podcast. That positioning doesn't lend itself to, and now we're going to launch an ETF and manage your money. Yeah. So, or, now we're going to launch Equity Mate's advice business and tell us your problems and we'll solve them for you. I think we very much see the value in being the connector rather than being the expert.
You guys could get that sugar hit by being like the GameStop version of the new ETF, where you just put a name on something, you come out and say that we are a terrible business, we're making no money, and people will buy it because you got the audience. And then you could sell all your shares at $500 a share and retire in the Bahamas.
So this
is sounding good.
This is exactly what we want to be on Wealth and Toil, an Australian finance investing podcast. Look, pump and dump is exactly what we want to be encouraging our audience to get into, right? Because people don't think I'm a crook already. Like it's, so going back to your person. Oh, go on, Dill. Go on, mate.
I was going to come back to that as well. So, talking, let's fast forward and talk about future ETF, but let's put aside the fact that you're going to be potentially giving advice or managing other people's money, but talk about maybe your investment philosophies and how you've built those and perhaps how they've changed over the last few years.
And I'd like to know who you think your biggest influence has been. Like who's, you guys talk to a lot of, clowns like me. What do who's really, when you've listened to them speak, just being like, whoa, that was sexy, that was hot. I'm going to put that in I'm going to put that kind of thinking to work a bit more often.
So I think we actually recorded our first investing book that we wrote, Get Started Investing, in audio form a matter of weeks ago. And it was an interesting exercise to read it and reflect on what we were thinking at the time 2.5, 3 years ago compared to the most recent book that we've written and sort of what our life is now from an investing point of view.
Available in all good bookstores.
Available in all good bookstores, absolutely. So
are there any good bookstores left?
Yeah, booktopia.com, amazon.com.
And so when I started out and for the early years of investing, despite what I was told, it was all about trying to find individual stocks and pick the winners and
cut your losses
and doing very little sort of proper due diligence. It was always led by like a headline statement. I think this company will do well for this reason.
Soundbite.
But that was pretty much it. And it was around, curating a portfolio that way. And ETFs played a part, but to be fair, when we started investing, I guess the awareness of ETFs was nothing like it is today. Even the number that were,
I think you guys have been a big part of that.
Listed.
To be honest.
Oh, thank you. And so I think we've also been in this epic position where over 7 years of doing a podcast, we've spoken to hundreds and hundreds of experts. And
not as handsome as me, but others.
Not as handsome as you, yes. And so where I'm at now with my investing is, you can't go past the long-term core portfolio set up over 40 years, broad-based exposure to global equities, low cost. That's primarily how I invest now. And that's become about in two reasons. One, I just don't have the time that I did back at uni and early days of Equity Mates to be thinking about looking at individual stocks in my portfolio because of the amount of time we spend on the business and other things in life. And I've learned that if you don't have the time to do that, it's not a good financial decision to still be just throwing money blindly at individual stocks. So, it's interesting you say, like, who do we take inspiration from? Like, we've had so many awesome fundies come on who are all active managers. Yourself, Nick Griffin, Hamish Douglas, who all speak, so well about individual stocks and get us really excited. But
you've never bought their product.
And I've never bought their product. Yeah.
Really?
Yeah. Sorry, I was in Magellan for a bit.
And how'd that go for you?
Not very well.
That's what I thought.
Yeah, but I haven't. I haven't bought a lot of their products. Yeah.
I mean, we've had this conversation offline as well, and I don't mean to put you on the spot, but I suppose I've never really invested in ETFs. I've always bought either active managers in the parts of the market where I don't think I've got a competitive advantage, and the places where I do have a competitive advantage, because this is my profession, this is what I do for a living. That's where I've invested in direct equities and tried to generate outperformance that way. I wonder why, with the level of access, I mean, I wouldn't classify either of you guys as an average investor. From my conversations with you, I think you're both well and truly sort of top quartile in terms of the average person who's not a professional in the street in terms of your knowledge. So why aren't you using an active manager when you know that a lot of them can add value consistently after fees? Like, what's the thing that's holding you back from giving me money to manage for your small cap Aussie equities or whatever?
I know that you guys can't see me, but I'm laughing silently because I knew that this question was
can we just unpack,
so far away.
Let's just unpack the structure of that question. Give us a big pump up, and then be like, "Why aren't you giving me your money?"
I think
I am a slick operator. Let's not forget that. All right.
I think because time and time again, and we speak about this on the show and in our book. There are very few fund managers who can beat the overall market, very few. And I'm very comfortable with taking the market return
minus a small
through
fee.
A core portfolio minus a small fee over 40 years. And yes, you could throw in Nick's fund and generate a little bit of alpha, but it's just something, I guess it's just something that I really haven't sat down and genuinely thought about, the value of having Nick's fund in my core as to complement my core portfolio. I think for me, it just comes down to my investing strategy suits my lifestyle at the moment. I know the long-term returns and the impact that's going to have.
The returns will be fine.
Is enough for me.
Yeah, I like that.
I'm not in the game of trying to generate 2% alpha year on year. It's nice. It would be great to have, and I love these fundies, but I guess I've just never made that next move. I think you're different though, Ren. You've made you have.
Yeah. So to answer your question, to start with biggest influence, not anyone we've spoken to on the podcast. Definitely for me it was Bryce. Because there's no way I would have started investing if it wasn't for Bryce.
So keeping up with the Joneses is the...
No. I grew up in a family where we didn't speak about
money.
Yeah, it's like you sometimes, now that we're so in this world, you forget about how little this world is spoken about by the average person. And I think that's something that we have to constantly remind ourselves and really level set around levels of knowledge, levels of interest and stuff like that. But yeah, I never would have started if I didn't meet you at uni and didn't live with you. So that's there's been a lot of good fundies on the show, but yeah, that's it. In terms of investing philosophy, I sort of break it up into two, so core and satellite. Core is my portfolio is a handful of index products, and I think people appreciate the index product, but they sleep on just how good a market cap weighted quarterly rebalanced index fund is. It is like this beautiful perpetual compounding machine. It cuts your losers and it overweights your winners, and it changes as the market changes underneath it. And it is just a beautiful wealth creating vehicle. And I think people sleep on just how elegant it is. We wrote a 300-page ode to the index fund as our second book. So don't stress, just invest. I can see Luke looking at me cynically. He's biting his tongue. But just for the average punter, because, even choosing an active manager requires some work.
It's a decision, right? And I think this is what you guys...
It's a decision that requires some work to make the right decision, is Correct. What I'm saying.
It's not as easy as you just look at the historical returns.
Exactly. And I think the index fund is just beautiful in that way. And people try and put twists on it, thematic, equal weighted, all that stuff. Forget all that noise. The beauty is in the simple product. So for me, that is the core, and there's nothing more than that. On the satellite side, I do own some active managers, and I think they will either... For me, there's two reasons why you go active manager. One, they're brilliant, and they justify the fees and then some. Or secondly, they're sort of esoteric. They do parts of the market that active really generates alpha, like small caps, emerging markets, stuff like that. So I have some active managers that I think fit one or both of those descriptions. But then for individual stocks, for me, it's really three things you're looking for in an individual stock. Firstly, can they consistently generate above average rates of return? Like, do they have a long-term sustainable competitive advantage that won't be eroded away? Secondly, do they have the ability to reinvest that at high rates? And, that's, in new businesses, in their own business, whatever it is. And then thirdly, is there a management team that can execute on the opportunity? And
no valuation?
Yeah, valuation for me is a factor, but it's definitely less of a factor than when I hear you talk about it. Because for me, retail investors, and I don't love that term, everyday investors really only have one advantage over professional investors, and that's time horizon. Like, the pressures of professional investors, of career risk if you're not performing, of quarterly reporting obligations, of your clients ringing you up and moving their money to someone else, like that forces, even if professional investors say they are long-term investors, it forces a level of short-term thinking or index hugging or mean reversion. Like, it just forces certain behaviors.
If you don't own it.
But like, I think everyone requires outside investment.
I think
you're investing someone else's money.
Oh, yeah. I think for me, running money, I think that's a competitive advantage of what we do at Seneca relative to your average institutional investor, is because Ben and I only answer to me.
Well, you also answer to all your clients who are putting money in the fund.
Of course you do, but at the end of the day, you still can take a longer term horizon. You can still take views on it. You can still do deep dive research that it's lasting and can add significant value over time. I think that having those career pressures, like no one pays my wages.
Yeah, you're not getting promoted.
I'm not getting promoted. I'm not looking for a PM job.
Or a bonus.
I'm not looking for a bonus for this year's quarterly numbers or whatever. I think the pressures of institutional funds management create a lot of the issues that we have in funds management.
So to close out where I was going with that, it's just the difference for everyday investors is that they can take a longer term horizon. They can, like, time horizon arbitrage, whatever you want to call it. And in that case, if you find real long term compounders, you can be less sensitive to valuation than a professional investor.
I agree with that, and I think that sort of plays on whether that's in your core portfolio or in your active portfolio. If you are disciplined enough and have the fortunate enough to have time on your side, and you can apply a disciplined sort of mindset to it, and get swayed, it'll work. I think the reality is, and whether it's doing the Pimp My Portfolio stuff with you guys or my experience the last 10, 15 years, 97, 98% of people, they don't have the discipline. When the stock price starts going down, they think they're wrong. And, as I tell clients all the time in this business, if you're buying stocks, you are wrong till you're right. Because if you think it's cheap, the market thinks it's not, you got to wait for everyone to come around to your way of thinking. And that's how you make money. And that's just the game. So if you want to be right all the time and have a portfolio full of green stuff that never goes down, you're in the wrong business, and it just doesn't work like that. But that's how most people think, particularly if they want to sell their product.
Well, Bryce put it really well as well, saying that, the approach has to suit your lifestyle. And realistically, if you want to spend 4 hours, 5 hours of an evening every single day reading company reports and trying to find, a gold nugget that's going to seriously above market compound over a very long period of time, absolutely. If that's what gives you kicks, 100%. In the same way, if you want to go and read about the hundreds of different fund managers that there are trying to build portfolios and understand who you think is the best, absolutely. The alternative is you buy the index or you pay someone to do it and you live the lifestyle that's important. That whole portfolio that suits your lifestyle and confidence that you're going to get there, like, I have that conversation every single day. That's the key, really. You either, if you really want active outperformance, you both have to pay the manager, but to be sort of conscious and comfortable with the decision, I think really, that's when you should be thinking about whether or not you should be seeking advice rather than doing it yourself.
I had as you know, guys, I'm exceptionally well prepared for all of our episodes and recordings that we do, and I like to spend a lot of time on deep background research and that kind of thing. I heard a from one of my sources who shall remain
we go.
unnamed. I heard that Bryce used to eat a whole packet of Tim Tams in bed every night before he would go to sleep. Can you confirm or deny this salacious insult that's been lobbed your way? Or
There
rumour?
were certain nights where I would be known to devour double choc Tim Tams.
That's naughty.
Yeah.
That is real naughty. And
I look back on those days with very fond memories.
and there was no...
You still tuck into the occasional sleeve of Tim Tams?
I haven't had a sleeve for a long time. No, we're more an ice cream or a block of chocolate.
What's your
family
go-to?
now.
I've got a go-to ice cream. What's your go-to? Like, if you're gonna have an ice cream, what are you running from Woolies or Coles?
I'm a Maxibon guy.
Wow.
Yeah.
Got a preference?
Like an almond magnum.
God, I knew I liked you, Bryce. I knew I liked you.
Yeah, those were uni days. Punching, look,
Punching what?
punching a lot of Tim Tams. Punching a lot of Tim Tams.
Gatorade.
Anyway, your sources are
Another
correct.
another area that's stopping Bryce from buying a lot more Tim Tams is the Sydney house prices. So correct me if I'm wrong, but you both have recently bought into the Sydney housing market.
That's correct.
We have.
Yeah.
Double Bay and Vaucluse between us. Very nice gentlemen. Very nice down there with the
We've
pier and the
we've
boat.
actually just come off Bryce's housewarming this weekend.
Yeah.
And, geez, it was so big. I don't think I saw every room in the place.
It must be difficult. And
Punch a few Tim Tams at the housewarming. But tell us, like, what like, you know, people have motivation for getting into the housing market, but how does that fit into your investment strategies
has
as
it
well?
changed your investment strategy?
Being a podcast that's largely about
Yeah.
you know, market-based things. Tell us about how that drove, or what drove that decision from both an investment and a personal point of view.
Yeah, I mean, there was a time where we were really ripping on property, and I think we got to a point where we were both like, you know, we actually want to get into housing here, and so slowly pivoted how we spoke about property on the show.
We on soft fade.
We were just negging it because we wanted it so bad.
because we wanted it. And then when we became clear we were going to get in, we started pumping up property. So, look,
Manipulating the market.
we both obviously wanted to get into property, and
Not that obviously. Like, I don't own a house. Got no intention of buying one.
Okay, yeah. If I, we okay. Let's
not. Luke is not.
let's put it this way. My wife probably wanted to get in property more than I did. Let's put it that way.
Interesting.
Potentially from a home ownership point of view.
Like family and have a house and
No, well, just like, wanted a primary place of residence. If I was to probably have full control over how we did it, I would have probably taken it and bought an investment property and done the rent vesting for a bit. I think, financially it probably would have made a little bit more sense.
And
but I'm not saying that I'm disappointed with the outcome that we have, because I think we spent a lot
Sorry,
of...
bro. Harriet's not going to listen to this.
No, but I think...
I was going to say the exact same thing.
Because I think we spent a lot of time, we spent over a year looking for property, and I think what we've bought is going to be a good investment anyway.
Do you care? I mean, so if I buy a house, which I probably will do, buy a house at some point in the next couple of years, but I'm not buying it to make money out of it. Like it's like buying a fancy car to me. It's just a lifestyle asset that I enjoy. It's something I'm
I
buying pure
definitely
emotionally.
didn't look at it like that.
Yeah.
I'm like, this is such a large amount of money that I want to make sure that what we're buying
It's good.
is good. Yeah, because like this is not going to be our forever home. It's just a stupid thing to think that I'm going to be here till I'm 60. So that like the probability that it's going to be sold is is high.
Is that when you're going to die, Bryce?
If he keeps punching those Tim Tams, he might do.
It is, mate.
That's around downsizes, right, or whatever.
No,
But
Well, I think that's when people should downsize, but that's a
Should.
whole other conversation about the amount of lack of downsizing.
Yeah.
We can talk about that
and
another night.
so I'm like, you know, I don't want to be in a position where we've just taken the next best thing because we were so desperate to get into property. It was like, I want this to be something that we're confident that when we go to sell, we treat it like an investment. There's going to be some capital growth there, and maybe we get to a point where we don't have to sell it, and it's going to be wanted by
Someone else.
Yeah.
It's interesting, you know, that just sort of really highlights to me the value of, or the importance of advice and financial information about your personal circumstances. So there's Bryce and I, both relatively high income earners, both business owners, both got a business partner, and, you know, probably not, I'm a bit older than Bryce, but not by much. I've waited a long time to buy a house. I've had the dough to do it for a while, but I've chosen to invest money in the markets and my own business. But I'm thinking of not buying an intermediate step, and I feel like the intermediate step was 5 years ago or 10 years ago. So I've just gone, nah, stuff that. I'm going up the price point and bigger and harder, and I'm going to buy once and they'll be done. And Claire and I are happy to do that. Are you sort of thinking intermediate step, or you're like, nah, this is home for me?
Yeah, so my partner and I are going to be in Sydney for the next 5 years, call it, maybe. But like, I think long term, we probably don't want to be in Sydney. Mm-hmm. So it's an intermediate step for, you know, then there'll be a lifestyle decision down the line. But in terms of why we bought, I think there's a psychological element to it. Like, you know, forget the pure financial rationalization, and it's like there was something just about getting out of that renting and you know, owning our own place, and, you know, paying down a mortgage and building some equity, and you know, maybe you can get better returns rent vesting, or you can get it in the market, but for us it wasn't purely financial. I think there was a little bit of that, and then the other part of it for me was always that I feel like the rate of growth, especially in Sydney, and what that means in terms of initial deposit and the rate that was growing, it was like, you can't save your way
Hard to
there.
catch.
Like,
Yeah.
you've got to really invest your way there, and you shouldn't really be investing a house deposit because you probably want to draw on it in, you know, 3 years, and you should really be investing for like 5, 7 plus. And so for me, it was always just a little bit of like, you try and catch the tiger by the tail when you can, and
You had the dough to do it, so you just like pull the trigger.
Yeah. So those were probably the two big factors for us. And you know, we
I think.
Sorry, you go, Dylan.
I was just going to say, I think it's a really good point, right? So not all investment decisions have to be entirely financially outcome based. They can be both, and, you know, particularly with physical assets, so houses. Luke made the point about lifestyle assets like cars, things like that. You know, you can choose to buy into a house knowing that it probably will appreciate in value at a similar, or because of the effect of leverage and compounding on leverage, potentially higher rate. So trade that liquidity premium for a house. But you're also then not paying rent. You've got the security of knowing exactly where you're going to be for however long you want to be there. So there's a number of non-financial benefits and that can be coupled with that financial benefit along the way. It's a really important thing when I think you talk about it, because the feeling of being in your own home and the security and safety that you have on that, and waking up on the 1st of January knowing exactly, you know, what your repayments are going to be and things, and not whether your landlord's going to come knocking in March and say, hey, here's your notice to vacate, you've got to go find something, and Sydney rent prices are going crazy, or whatever it might be. That's worth significantly more than an extra few percent in the market. Plus your deposits growing at a rate of, you know, compounding at maybe 4 or 5 times what it would be if it was just invested elsewhere. So
Yeah.
It's all personal though. Like you raise another thing that I can sort of relate to, is that I've already done the sea change sort of thing. I go between.
True,
I
yeah.
live in Torquay, and I go to Melbourne. A couple of days a week, and I'm up here. Relatively frequently as well. But having the two places sort of is It's different again. So it is really personal.
Yeah, no, it's different. It's different because you pay two different people's mortgages.
That is 100% correct. That is 100% correct. And I love every minute of it.
So you were talking earlier about the benefits of paying for advice, and one area where I was pretty skeptical about it, but after having gone through the process, I can say it really helped, and I found it was worth it, was a buyer's agent. So I don't know what you guys think about this, but we were looking, so we were renting in Coogee, which is by the beach in Sydney, and we liked the beach. We wanted to stay there. Couldn't afford Coogee, but we were looking, around that area, and it was just a nightmare. Like, everything was listed and then would sell for like 20 or 30% more. Probably a bit of real estate agent tactic there. The lines out the door to inspect anything.
Yep.
It was just brutal.
Too much.
Places we saw where we were like, oh, this is interesting, it's in our price range, would just sell for well beyond our price range. And so we got connected with a buyer's agent through our mortgage broker, and they're expensive and you got to pay them out of the cash that you've got. But he picked us up in his car, gave us a chauffeured Saturday morning, taking us to inspections. About half the inspections were unlisted places. And we ended up buying an unlisted place before it was listed. He negotiated on our behalf, got it below what they were trying to sell it for. And it was great. It was like ticked all our boxes. And it was just like one of those experiences where it was like, there was no way we could have done this without the professional help and that person's connections.
Even me, I used to buyers. So I almost bought a house a couple of years ago, and I used a buyer's advocate for that. And I actually didn't even use him for the search. I still used him.
Okay.
So I was like, hey, I just want you to go and buy that house for me. I just don't want them to know who's buying it. I don't want to deal with an agent. I don't want to negotiate. I don't want to manage the process. Go and sort it for me, and I'm happy to pay you and just pay the dough. So I'm big on outsourcing. I'm big on kind of like what you were touching on before, Bryce, like spend all of your time and effort in the thing that gets you the highest possible return on invested time and effort. So, I try and spend as much time as I physically can in my business and as much money as I physically can in my business, because that's when my returns are the best. And I think outsourcing human capital and outsourcing the things that you aren't good at or don't want to do to people who are good at it and do want to do it is a really smart strategy that not enough people take advantage of, and everyone's trying to save as much money as humanly possible, when in reality I think time's the actual asset you want to buy when you've got money. And I want to spend my time doing the things I'm passionate about with people that I enjoy doing it with, and not trawling REA.
To bring it back around to the start, it's like it's your critical hires, right? Like the 5 professionals that you should have around you are your critical hires that you're getting in your business. They're the people that are experts in that area. Like you, Ren, we used a buyer's agent to buy our place in Tasmania in the middle of COVID, when we couldn't travel, there was not a chance we were getting down to inspections or anything. And it was an incredible experience. I've used a number of different buyer's agents in Victoria, Sydney, Brisbane, Perth for clients, and the returns on for a client in Victoria to be able to buy a property in Perth, and have confidence that we've got a 5 to 7 year plan of what the capital growth estimate is and what we're going to sell it. That's impossible. It's literally not possible for you to do that interstate without traveling back and forth with confidence, right? So you could call a real estate agent, make an offer over the phone based on some pictures online, but do you really want to do that? So yeah, it's a wonderful service, and a good buyer's agent is worth their absolute money.
Yeah.
Guys, I don't want to keep... I'll go on, Dill. Sorry, mate. Yeah.
I was just going to say, can I wrap this up with a couple of questions and quick fire answers? Best financial advice you've ever been given, and the worst financial advice you've ever been given.
If you guys use me on the second category, I'm going to be bloody flat about it.
This isn't a purely financial advice, but it's related. John Hempton once said on a podcast, everyone should read 5 investing books. It doesn't matter which 5. And I think that is something that every Australian could benefit from. Just read 5 investing books.
One of them should be Equity Mates. Get started
Yeah,
investing.
we got 2, so you can tick 2 off. But
no, 2 of them should be Equity Mates.
worst. I mean, it's all the myths that you always hear about investing. It's the I don't have enough money to get started. It's too risky. Investing in stocks is gambling.
What about you personally have been given? So something that you've been told.
Worst thing you've heard on the podcast.
It's a tough one. Without naming names, it was to withdraw money from Swiftex because it was going out of...
Oh, true.
Because it was going out of business.
I had a decent position in Bitcoin and Ethereum at the end of last year. And then, someone was fear-mongering about the crypto exchange I was with. Sold it all. And crypto's ripped this year.
And you're flat about it.
Yeah, luckily I got some back in. So don't worry. I've still got crypto.
And Bryce, any words of wisdom or lack thereof?
I guess this is recency bias, but it was actually from Charlie Viola and one that I've implemented into my portfolio. He was saying that so many people, when they start out and for probably too long, build a portfolio of little positions, 500 here, 1,000 there, $50 there, $50 there. And you get to this point where you know that you should be building large positions in just a few select things. And I think he put numbers around it, like if you've got a portfolio of sub 100 grand or whatever it was, I can't quite remember, but you really should just have like 3 lines, 3 big lines that then just compound over time. And then from there you start going, where else can I be putting money? And I looked at my portfolio and saw all the stuff that I bought in uni and through the first years of Equity Mates and really thought, I did have 3 big lines in leverage portfolio, ETFs and those sorts of things. So I thought, I understood what he was saying, tried to put that into practice a bit more, so consolidated a bit, and it's working wonders.
I hate quoting this quote because it really, he used to ram it down my throat on a daily basis. But Warren, I used to work for when I was young, always said, you need concentration in your portfolio. You need to have concentration, and you have to, if you want to make big money, you got to speculate a little bit to accumulate, and that's part of it. So I think that it's really good to have conviction in what you're doing, whether it's your business, whether it's your portfolio, and particularly conviction in areas where you have expertise.
I think it's concentration builds wealth, diversification protects it, or something like that.
It's a good axiom, and I like it. And Charlie's making squillions for a reason.
Yeah.
What about your worst?
Without concentration.
I genuinely don't.
Look at him go.
Worst pieces of financial advice. It probably comes back to, I actually can't think of something that I've enacted, but it was probably early days of getting numbers put in front of us when we were buying a house, and just how the banks would put what you can borrow versus what you can actually afford. And luckily we didn't.
Wait, they wouldn't tell you what you can afford. They would just tell you what you can borrow.
They would just say, here's what you can borrow. And you're like, are you fucking dreaming? Like,
I can't service
25 grand a month.
And I think I can understand why people get themselves in a lot of trouble by looking at these numbers and not actually doing the work themselves to understand the difference between what you can afford to borrow versus what you can actually afford to pay from a mortgage point of view. So other than that, Don't take your financial advice from banks.
It's pretty
probably
irresponsible.
Not from mortgage brokers
I think it's
either.
really irresponsible. Yeah. And I can understand people get really excited when the bank says you can borrow, 5 times your income or whatever. And they go, great, I'm going to go out and look at all these properties. And then when they probably plug it into the Money Smart calculator and it goes, this is how much your repayments are going to be. It's like, oh shit.
Yeah.
That's like, what? So...
That's if they're clever enough to put it into the Money Smart calculator before they put a bid.
Well, I'm self-employed, so the bank won't lend me any money anyway. So
we had that same issue, but I think that the banks are coming around a little bit more.
Like I haven't done it for a while. So I'm trying to avoid going to a bank if I can. But
when we first spoke to a mortgage broker, there wasn't a lot of options, but one of the big 4 banks kind of changed their policies around it.
We were still very limited.
Yeah.
We could get away with it by just showing that we're paid by Equity Mates.
Yeah.
most banks, and I think there were 4 or 5 options. If we wanted the whole suite of options, we would have had to have been tied to the performance of equity mates, which, that's something that you don't want to be doing.
Yeah. But 9.5 is a good mortgage rate at the moment, isn't it?
I've got jokes here, but I'm going to refrain. I've got jokes, but I'm going to refrain. In the interest of time, boys, I'm going to wrap because it's been way too long and you're busy. But look, we really appreciate you guys coming on our little pod as a personal favour, really, and I'll pay later. But I'm just really, I'm so impressed with what you guys have built here as a business. As I've told you many times before, I think you're both super impressive people, and the team you've built here is a really impressive team. I love working with you. I really enjoy our chats and what we're trying to do with the community at the moment. It's really exciting for me, and I'm glad that Dill gets to be a part of it a little bit as well. But look, really appreciate bringing your presence and gravitas to our little pod. So thank you very much. And,
no, we appreciate it. Thanks for having us.
Thank you very much, boys.
Guys.
Look, everyone, thanks.
I think that's a wrap for Wealth and Toil.
It's a wrap, Dill, mate. Always a pleasure to chat to you and appreciate your input today.
Never a chore, mate.